Where Will We Work Now? The Future of Office, a Tangent original series. By now, odds are you've either worked from a co-working space, heard about them, or are listening from one right now. And today, over 3 million use co-working spaces worldwide. The way and where we work has changed forever. Remote, hybrid, flexible, it's a whole new world out there. Yet, face-to-face interaction is more needed than ever. In this new series, Jeffrey Berman, Zach Aarons, and Edward Cohen will explore the future of the workplace and how office spaces are being reshaped. We'll take you on a journey to understand how the very nature of office buildings is evolving. How did we get here? And where are we heading? Join us as we explore the modern office and how prop tech founders, real estate owners and operators, and VC investors are reimagining its role across cities. Because in real life, and in office, will always be where innovation meets collaboration.
Hi, welcome to Tangent. I'm Edward Cohen.
Hi there. Welcome to Tangent. I am Jeffrey Berman.
Today on Tangent, we have Eliot Brown, co-author of the book The Cult of We, WeWork, Adam Neumann, and the Great Startup Delusion. Eliot's book was depicted in Apple TV Plus series WeCrashed and is a Wall Street Journal bestseller, a Financial Times, Fortune, and NPR Best Book of the Year. Hi, Eliot. Where does this podcast find you?
Happy to be here. I'm in London, where I've lived for the past year and a half.
Bloody hell. Today I'm actually recording exactly 1 block away from 154 Grand Street, the location of the first ever WeWork in Soho, New York.
Where the magic all started.
I gotta say, I just have to say it. I loved WeCrashed. Jared Leto, also in the show, was absolutely ethereal. Like I thought I'm sure a lot of it was, well, it was. There was a lot that different from the book, but so good. And I'm just curious from your perspective. I know we're jumping right in, but did you watch it?
Yeah. I saw it when it came out.
How did you feel like it stuck to the source material? And
yeah, I mean, just to be clear, I think they read our book, and definitely there were some scenes in it that they were sort of doing their own thing. I thought it was really good. Like, I mean, I was expecting it to probably be like 60% accurate, and it seemed like it was probably like 85, 90, which is like, wow, this really did happen like that. And I thought like Jared Leto was a really great Adam. He kind of just got the whole vibe of the guy, if maybe a little bit shorter than him. But yeah, I thought it was a little long. It was like our audiobook was probably like 13 hours and this thing was 8 hours. It's like, wow, you really could have done this in 2 or 3.
Yeah, but it was so good though. Sorry, I already went on a tangent.
No.
Well, that's what we do here.
That's what we do here. That's what it's all about. I did not watch the series. However, I did binge listen to the book. And honestly, I didn't even know what could else have been dramatized beyond what the book describes, because it's already drama infused. But Eliot, so you covered WeWork first as a real estate reporter and later as a venture capital and finance reporter for the Wall Street Journal in San Francisco. Want to ask you, why did you write the book? Why did you think it's important to tell the story and learn from it?
Yeah, so WeWork was always kind of a minor obsession of mine, and then grew to be a major obsession as it got kind of bigger, crazier, more valuable, and then spectacularly imploded. And I think just, me and my co-author Maureen, when WeWork was just about to try to go public and it blew up, we were just every day, sometimes 3 times a day, just finding these new crazy details about Adam Neumann and the company and how it was run and its corporate governance and the money being burned. And it was just like, this stuff does not happen very often. Like, we don't just, the stories like this just, don't land on your beat very, very frequently when, you're really kind of feel like you're in the room, because, I've been covering for years. Maureen was super close on the finance side, and we just felt like we had our fingers really on the pulse of this like totally fantastic story about a mania and a bubble that is still rippling today.
Absolutely. I mean, not only did most WeWork investors lost everything, employees also didn't get any upside in the eventual IPO. While the founder, Adam Neumann, did take home well over $1 billion, of course, enabled by SoftBank.
The early investors, really early investors, of whom I know a few, made a killing. This is anecdotal. It's secondhand from someone I know well and who was an investor. But I think there was like an opportunity to sell out at a $20 billion valuation. And
yes, that's right.
And so he took that and did really, really well. Like it bought him a house in the Hamptons, it bought him an apartment in the city. And like it was, and so it's interesting because this is the point I was trying to make, was more about the board than the actual, like it happens that investors along the fundraising life cycle of a company, some will do well, some will not do well. Ideally, all investors do well, but that's just not how it works. Some you have in later rounds, sometimes you have structure, et cetera, et cetera. But I would really love to talk about how the board was interacting with the company and allowing a lot of these shenanigans to happen, because why?
Yeah, totally. I mean, there's these kind of weird incentives in the startup and venture capital world where a layman's definition on the street of was it a success versus some board member or venture capitalist definition, which is, did I get a return on my money? So there's all sorts of failed companies where investors see it as a total killing and they thought it was a huge home run. But you know, to you or me, these things don't even exist. They went out of business. So yeah, happy to dive in on sort of like, you know, the board and their governance and like, I mean, to me, the WeWork story is completely one of a set of enablers that kind of just collectively deluded themselves about what WeWork was. They kept feeding it more money and just kept saying yes to Adam because he was good at raising more money from other people. And so sort of collectively, they weren't looking around and saying like, this isn't a tech company. This is a money losing real estate company, which is what it was. But instead they just kind of pumped up the mystique and valuation.
Yeah. Something that I was kind of surprised while listening to the book was that, you know, I was like maybe halfway through the book. And I was like, where is SoftBank? When are they entering? Like, you know, they definitely put the most fuel to the fire. I mean, for context, I think recently they just said that the losses on WeWork were around $14 billion, which is 7 times the value of WeWork's similarly sized competitor, IWG Regus, which a company that was founded in the 80s, providing office space. They were not branded as nicely. They didn't have as charismatic or as good salesman of a founder. But we know how to value these things, right? They're a real estate company providing office spaces or leasing and subleasing them to workers. So I think that really surprised me in terms of how, you know, we just love a good story.
No, that's a big part of it. I'm a venture capitalist, so Camber Creek, we invest in companies that are accretive to the built world. We looked at WeWork a number of times and could never wrap our head around how this was technology. We looked at Notel and got close with them and then realized same thing, right? Like this is not technology. Not that they weren't, and here's where it might be controversial, not that they weren't great companies or great ideas. Like here's what I give Adam credit for, Adam and Miguel, and I suppose their whole founding cohort. Yes, flexible office space, small spaces existed well before WeWork. But they changed the relationship and the way employers looked at flexible space in a way that no one had done before. So we can separate valuation, we can separate shenanigans at the board level, shenanigans at the corporate level. But if you just look at the concept itself, WeWork as a concept, co-working as a concept, as a flexible, malleable space for people to go that don't want to be in a 9-to-5 normal stuffy office, they changed that, I think, permanently. And so I do give them a lot of credit for that. It's everything else that's the like, oh, wait a second, how did this company get the billions in funding? Where did all that go? Why were they signing all these leases? Why did they let this guy buy a plane and smoke dope on the plane? Like, what was happening there? And that's the questions, like, where was the board?
Yeah, just on that notion, I guess I have, often wondered, today WeWork is, in something like 700 locations or 700 cities. It's super ubiquitous. It's the biggest tenant in New York and London. And work, the way a lot of offices and companies approach work have changed. Would we have had any of that change if they weren't subsidized by venture capital? Meaning, if they had just started and tried to bootstrap, tried to run a company based on sort of normal merits without portraying it as a tech company and gotten funding that way, my guess is, would love to hear your thoughts, but my guess is, it would still just be 5-10 locations in New York and a handful of mom and pop operators doing something, in every city around the country. Because I think WeWork and its competitors then sort of just drafted off the venture capital that was pouring into WeWork.
Yeah, I think you're right. And there's a broader point that I think you're teasing at, because if we look at Lyft and Uber, and I'm not following the stock, so I don't know or DoorDash, I don't know if any of these companies are profitable yet. But
yeah, I think Uber's finally figured it out.
So Uber's they were fueled by venture capital for a decade plus, massive losses, subsidizing their customer set. So the question is it necessarily a bad thing? I'm not shedding a tear for SoftBank. Yeah, they lost billions of dollars. That's boo-hoo, that's their fault. But they did help create this revolution. And if we think syllogistically what the effect of the WeWorkization of office is, so I don't know how much you know about real estate finance, but so you probably know a lot. When you buy a building, you typically look at something called a 10-year Argus run, right? Like you want to understand the cash flows of the building. That no longer, that notion doesn't really exist anymore. Now, a big part of that is the pandemic, of course, but this idea of flexibility, plus this idea of, okay, well, people are now working from home. We don't really utilize space in the same way that we used to use it. I think that WeWork played, I don't know how large a part, but some part in changing that dynamic such that the way that this entire asset class is going to be looked at from a financing perspective may change, and the way people use their office may change. The way that people are blending lifestyle and work style has changed. So like we have 300 plus real estate strategics that are investors in our fund. I'm not going to name any of them, but a very large one, very well known around the globe. If you look at their offices now, they look more like a WeWork than they did in there when the company was founded 100 years ago. Really interesting.
Interesting. I want to take back shortly for the comparison between Uber and Airbnb, because during WeWork's rise, that was a lot of the justification for just increasing the valuation of WeWork, right? However, I can't wrap my head around that comparison, because Uber wasn't renting cars and Airbnb wasn't renting apartments or homes, while WeWork was on the hook for rent. Now, to Adam's credit or to WeWork's credit, they did get a lot of things right, like in terms of the vision, not only the desire for community, even though in reality, as we know from the book, when WeWork was running surveys internally, if members were friends or members knew each other, they actually found out that wasn't true. And me personally, when I worked at East 57th and Lex WeWork, which was a beautiful space, I also felt that. I tried connecting with my fellow neighbors, and it wasn't easy. There was no such real community in practice. Attention all hospitality owners and operators. Are you tired of spending endless hours managing guest communication and figuring out ways to upsell your services? Well, we've got some exciting news for you. Introducing HostAI, the revolutionary AI concierge designed exclusively for Airbnb and short-term rental hosts and boutique hotels. Say goodbye to endless hours spent on guest messaging. HostAI automates the process, ensuring that you're only alerted when matters are truly urgent. That means more time for you to focus on what really matters, providing exceptional guest experiences. HostAI isn't just a time saver, it's a revenue booster. Unlock personalized upselling opportunities triggered by past guest conversations and calendar inefficiencies. Watch as your revenue grows effortlessly with targeted and timely offers. Imagine training an expert AI model on your properties in just minutes. How? By seamlessly combining your PMS and external databases such as HostAI and Google Sheets. That's right, with HostAI, you can harness the power of artificial intelligence to transform the way you manage your properties and communicate with guests. What's the key to satisfied guests? Quick, convenient, and accurate responses. HostAI delivers just that. Enhance your guest experience with prompt and precise information related to their stay, leaving them with a lasting impression. Ready to transform your hospitality game? Visit hostai.app to learn more and get started today. Don't miss out on the chance to streamline your operations, boost revenue, and elevate your guest satisfaction with HostAI at hostai.app. At the end of 2022, WeWork was still operating across 44 million square feet, which is the equivalent of around 20 Empire State Buildings. So, Eliot, I want to ask you, even though WeWork's valuation did keep going up, at least on paper, until almost the very end of Adam Neumann's reign, many things were going wrong internally. According to you, what specific moment or moments in time do you think it really all started going downhill for WeWork?
Yeah, I think the way we when we sort of like dove in and really did the kind of autopsy of everything, the way we effectively saw it was that it was this crescendo of venture capital, of Adam's ego, of sort of like crazy spending and crazy luxury and expanding ambitions through the end of 2018. And so at that point, I mean, by the time you got to sort of like summer 2018, that's when they were discussing a purchase where SoftBank was going to basically buy WeWork and put up $20 billion and value it at 45 or 50. Adam suddenly started talking to aides about, we found all this stuff. We're like, I mean, he started talking in this way where everyone just kind of normalized, like, oh, well, that's just Adam. But he's like, one day I'll be, I would be president of the world if I were to run for anything. And, he started to tell people that a Middle East peace treaty will be signed in a WeWork. Which today particularly sounds not likely. They started a kindergarten, a preschool aimed at elevating the entrepreneurship and the spirituality.
A very not good name.
We Grow.
Yeah.
His houses grew to I think that then it was 7 or 8. Was by the time he got one. He got a house in California with a room shaped like a guitar.
Wait, you don't have one of those? Weird.
And they owned 3 in the Hamptons, one of which they didn't use.
Where do you think they would put their cars? Come on.
Wait, what about, excuse me, the hairdressers and the surf instructors deserve also their own house? I'm sorry.
Very good.
You're losing me with all this bashing because, like, I get it. I have 3 different Lego sets of houses, and I put my tiny babies in each one. It's like same, but different.
Yeah, so he was basically always out of touch, but by the time you got to 2019, I think he didn't really see it, or late 2018, and yet then people around him would be like, so the entourage has grown to literally the hairdresser, the surf coach's, family, nannies for the surf coach's family.
Is this real?
Yeah, this is real. I mean, they would follow these people all around. And then in the summer, I think it was 2019, they rented a 2 to 3 other houses in the Hamptons for the surf coaches. They had lots of them, and sort of other staff that would come in.
Yeah. Now, WeWork pulled off a lot of tricks. Some of them were creative and original. Some of them were just borderline illegal, especially on the accounting side. But I want to ask you, Eliot, what tricks you think had the most impact in WeWork's trajectory, or which ones shocked you the most, at the company level? I mean, first one that comes to mind is how WeWork paid rent, right? And their concept of community adjusted EBITDA, which in essence, it gave new companies renting space a first year free. So new locations looked super profitable because it wasn't yet incurring also in the cost of that rent either. For example, in 2017, that turned 100 million in losses to 200 million in profit on paper.
Yeah, community adjusted EBITDA was certainly the funniest name trick. I would say their accounting was not the biggest thing. I mean, what they were trying to do with community adjusted EBITDA is what lots of companies try to do, just with less funny names, which is try to show a profit when you have losses. And in the end, when they were trying to IPO, the SEC essentially struck it down. So it was really bond investors who sort of got that info. I think at least sort of at the end of the day, I think Adam's skill was not lying about numbers, which he really didn't do. But getting people to, he'd present the real numbers. You or I could look at them, but the way he talked, you just not even see what the reality was. So people often ask about comparisons with Elizabeth Holmes. I think she was essentially saying this box that does blood tests, this works, and it didn't. He was saying this box, this is a tech company, and it's going to be really profitable in the future. And anyone who would like actually look at the box and then look at the numbers would be like, well, it looks like a real estate company and loses money. It actually performs worse than a real estate company. But his magic was when you're in the room with him, moving past that. And he did this to really sophisticated people. Like we have this anecdote where he got a really, star kind of fund manager from Fidelity, which had already passed on the company had already passed on an earlier round. But he just got the guy to, within minutes, just kind of eat out of his hand. We're talking about how he's like, you have energy. WeWork spaces, they have energy. You get it. And so then a lower level person at Fidelity flagged like, hey, we're running the numbers. This doesn't look good. And she was overruled by this fund manager who just said, no, I believe in Adam. It's about the future and we're doing it. And that's how they put in hundreds of millions at a, that was $10 billion valuation.
So I'm torn about this because there is something to be said for the charismatic founder with what I'll call, or actually my father used to call, the X factor. And again, let's pull this apart. Let's pull the massive fundraisers, even though obviously it's related. Let's pull the shenanigans. The fact of the matter is he and the founding team did create something that changed our industry. So in some sense, that what that person felt was real, right? Like there was that, I cannot believe I'm getting caught up in this. But then it becomes, okay, is this a fiscally responsible? Am I following my fiduciary duty as a fiduciary for other people's money, investing in something when the numbers don't work? So let's break those two things apart, because I think shame on them for investing when somebody actually flagged, hey, the numbers don't work. But I also understand that I want to be a part of this. I think this person is going to make it work. Now, that level, again, at 10 billion, I don't understand how they came to that, but I do as a VC who meets with people all the time. I have met founders. I have a very large angel portfolio. I no longer do this, but all the angel investments I've made have been based on the person and less so the idea, because great people will be able to pivot the idea to make it work. And some of them have done really well because the people have been so good. That's where you start talking, like I'll say again, where was the board? Where was the board? Like, was the board not reviewing these financials and seeing like, wait a second, this isn't adding up? Or were they just along for the ride and saying like, yeah, whatever?
So I think what you said really captures it, which is there's this kind of meme in Silicon Valley that these well-spoken visionary founders are these omnipotent beings, and you just need to park money with them and back them, and they will do amazing things. Because that's such a meme and because you have funds like Andreessen Horowitz and Founders Fund that kind of push this notion, 10 plus years ago, that changed the market in Silicon Valley, where people gave these founders the keys. And so the notion of, if you're just saying, I'm going to open a coffee shop, I have no money. Would you give me all the money to do that and complete control, even if you own 95% of the company? like no one would say yes, right? Like if you're funding 95% of the business or 100% of the business and you own 95%, you're going to want to say. And what happened in Silicon Valley is under the sort of, flag wrapped around them as omnipotent founders, then you suddenly had people like Adam Neumann with no control from their board. So he did have a board. They had very smart people on there who I think kind of deluded themselves and now are sorry about that for the most part. But had he wanted to, had they really moved against him and caused him trouble, he could have fired them and pushed them off. That would have been a big move. And I actually usually argue the opposite point, which is, when a $63 million jet came up for board approval, yeah, it was passed unanimously. But then you ask each of these people like, well, if none of you liked it, why didn't you vote against it? Because then it wouldn't have passed. But at the end of the day, Adam really did have the trump card, which is that he controlled the board.
Yeah, Adam had 10 votes to 1 in the board, and he was trying to get 20 to 1, similar to Mark Zuckerberg. Not sure if he still has that. But I think all of this is explained by incentives in a way, not only the board members at WeWork, but also more, the really savvy, seasoned people that were at Fidelity and mutual funds and that were also at JP Morgan. Like there was this FOMO, as it's described in the book, that they wanted to be involved in the next big tech thing, that they felt they had missed the boat on, in the first wave of the Amazons and the Facebooks. And this was their shot. And I mean, yeah, it's fascinating what humans and incentives end up doing in this sense. Something that I like to hone in a bit. You both hinted at this evolution of VC strategies to funding companies and how they view or how they value founders, right? Back in the day, it was first thought about the idea or the business to disrupt, and then VCs went on to find that the founder to lead this. And once it grew, founder then stood aside and VCs would handpick a professional, quote unquote, CEO. I think Bezos, Zuckerberg, Jobs really changed this, right? Driven founders with skill for salesmanship really changed this for a good reason. But yeah, maybe 10 or 20 to 1 for any given individual is a bit outrageous, or is asking for trouble.
Yeah, I mean, Bezos doesn't have founder control. He didn't. He just owned, a large chunk of the stock. So, and he was just doing a good job there. So it's Steve Jobs who all this is sort of based on. He didn't have founder control. He was fired and then brought back and still didn't have founder control. I think essentially it was a creation of VCs trying to look for an edge to say like, hey, founder, I'll give you extra votes if you take my money. And sort of created this now standard in the market, which can be really dangerous for investors.
So it's interesting because I want to be really careful with how I phrase this, because it's a negotiation, right? Like you alluded to. If a company or a quote unquote hot founder is trying to raise money and he or she has or is selling a great story like Elizabeth Holmes clearly did and like Adam clearly did, and you have investors willing to cede control, again, I don't know whether or not that's a bad thing or that's just the market acting and reacting. In other words, when I'm looking at sending a term sheet, I'm going to negotiate for the best deal I can for the benefit of my investors. And then if and when I become a member of the board of that company, having the best interests of the stakeholders, stockholders, investors in mind while I'm acting. And if you see that as an investor, if you say, you know what, I'm giving this money, well, then shouldn't the investors in those funds be second guessing their investment in those funds? Shouldn't the investors who blindly back, I won't name names, but certain venture funds with massive amounts of money from their pensions or endowments or et cetera, scratch their heads and say, maybe they're not doing the homework they say they're doing. because I don't necessarily fault a founder for taking advantage of the leverage that he or she might have in a negotiation where there are lots of parties trying to pour money into this person's startup. It's very easy for me to see both sides of this.
I mean, I think at the individual level, if people are sort of, doing the rational thing. But there's a reason that you can't. I mean, there's a reason the public index funds don't allow dual class stock. There's a reason that this is generally like seen as really problematic by corporate governance people in the world, because venture is not a very like efficient market, right? I mean, overall, it does worse than the S&P generally. Not if you measure at the top 2021. But like, it's not transparent at all. It's highly illiquid. It takes 5 to 15 years to find the result. So what happens in venture is people are drawing these trend lines and sort of making these assumptions about what's going to happen only on the way up while everything is going great. And they're like, well, look at Travis Kalanick. He's doing awesome. Let's do what he did. And it's like, okay, well, wait 2 years and that narrative can completely change. But suddenly all these founders have, large voting shares and large pay packages, which is another thing that a lot of them had.
I want to ask you both, like in terms of this culture of optimism and cheerleading. I mean, humans, we've always needed leaders, right? With vision that rally the troops, that, really that bring on the necessary elements combined with inspiring storytelling. Can you point to any like real estate or tech leaders that strike a balance between boosting teams to achieve greatness while also keeping themselves and the team humble and grounded currently or historically?
I have a number of examples, but the one specific one I want to use, I can't because the company is in stealth. But this is a company that began its life in 2020. It did $8 million in business in 2020 and was profitable. It did $34 million in business in 2021, profitable. It did $57 million in business in 2022, profitable, all bootstrapped. And this is a deal that we helped create. This person wasn't looking to raise money, and it took me about a year to get them to agree we can help accelerate your business. These people could be the very type of people that would have this mindset of my poop doesn't stink and I'm the greatest and all this wonderful stuff. And that's been the exact opposite. Not only that, they were rational about valuation. We ended up, and I'm not going to say the number, but it was one of the better deals that we'll ever make, because each side understood the value the other side was bringing, and there was none of the Eliot, I love the term you used before, that memization of it just, and when people find out who this person and who these people are, they're gonna be like, oh wow, that's pretty cool. I'll bet they paid a fortune for that. They're not going to know what price we paid, but so there are people. And this person has overseen a company that's gone from 80 people to over 300 in a year. Magnificent manager. There are people that are incredibly capable, that are incredibly talented, and that are rather adroit at all the manifestations that are necessary in business, that don't necessarily need to buy a $63 million jet and smoke dope on it, right? Like, I think we're talking about outlier cases here. I mean, maybe, Eliot, you're on this all day. Would you say these are outlier cases, or would you say there's a fundamental problem, or both?
I think that the companies that tend to dominate and sort of grow fast and are magnets to venture capital do tend to be run by people closer to the Adam Neumann school than like the Warren Buffett school. I mean, that's just sort of what everyone gets excited about. And salespeople are what bring in money. The one to tie it to WeWork, I think one way I'd answer this is if you look at the CEO of Industrious, the kind of the lift to WeWork's Uber, or maybe the tiny lift to WeWork's Uber, Jamie Hodari is the CEO there. He's It seems like a sort of like academic who had a couple MBA courses and is in charge of this co-working company that's competing with WeWork. And he got went on the jet with Adam and was like, why are you feeding me tequila at 10 a.m. Or Bloody Marys, like that type of vibe. He's still standing. His company exists today and isn't bankrupt.
Eddie's company, Convene,
is really large. Yeah. I mean, exactly. Like those guys are sort of like, more boring real estate guys at Convene.
Whether or not they end up being good venture investments, we didn't invest in either. So I
right, and both might not be. I mean, I imagine both aren't going to be great. It's certainly not like going to get the days of getting tech company valuations for a co-working space are gone. But they're real companies. At least I haven't followed Convene lately, but Industrious still is.
Yeah, no, Convene certainly is. There's a place for all of it. And again, I do think it comes back to the people that are around you that should be facilitating good governance. And this is also part of a venture capital problem. Like, there's such a thing as sitting on too many boards. There's such a thing as in being involved in too many things. Like, there's a natural limit to how many boards I can sit on and still do my day to day. Because if you are a responsible board member, you're on top of the company. I can't remember where I read this. This was brilliant. Someone was saying being a good board member is like being a grandparent, not a parent. If it's a parent, it's too close, right? But if it's a grandparent, and maybe in certain communities where the grandparents are really close to the whole families, like not like the grandparents that see you once or twice a year, but the grandparents that take an active involvement in your life, because that's how it ought to be, unless things look like they're getting dicey. And you should be able to see the signals of what's coming when you're reviewing the board financials. You should be wondering, asking questions. That's part of what being a responsible board member is all about.
Absolutely. Well, one example that comes to mind is actually someone we hosted on Tangent, Marshall Cox, the founder and CEO at Kelvin, which are helping buildings basically become more carbon efficient. And he did say that during fundraising, I mean, he's a scientist, a PhD, and during the previous 10 years, something that really hurt them in terms of fundraising was that they were following the numbers and sharing them as they were. They were not exaggerating or promising the moon while still creating value that will be, that will hopefully be a viable business. So
it's funny because from a venture capital perspective, so let's look at the landscape. This is not what we do. I want to be very clear. Like, there's a reason that we have done as well as we do, because we do not have this mindset. But you'll have certain investors who come in more sophisticated early on and say, I want to sell it to A or the B and make a quick 2, 3, 4, 5x. And they're basically selling the sizzle, right? You're meeting the people, you're helping them craft the story, and then boom, you're out. Then there are the more sophisticated investors that are like the pre-IPOs, like the Wellingtons, that can see like, okay, this thing is going pretty well. If it's going well, then there'll be no added structure, no weird liquidation preferences, et cetera, et cetera. But they're the ones that the smart money that comes in the end, that typically can compound their return in a rather short period of time. Great. The life cycle investors are the ones that have to be the most careful, and they have to be the ones that should be hewing to the entrepreneurs that are telling it like it is, and should have diligence that responds to, oh, let's uncover what's actually happening here and make an informed and educated decision. Far too often, because Eliot, you said it before, you're like, as an asset class, doesn't really perform very well, because if you're just throwing spaghetti at the wall, not a whole lot of it's going to stick, right? That's part of the reason why we're very sector specific. We invest in what we know. And so I think as an industry, and it's not just venture capital, right? Like, people in general, they want to feel like they're part of something. They want to feel like they're part of something energetic and sexy, et cetera, et cetera, et cetera. So it's like,
Yeah, but would I rather invest in a Marshall Cox type business over a Adam Neumann type business because of the type of investor we are all day long?
Interesting. Jeff, want to ask you and also Eliot, claiming that you deserve a tech valuation while actually being a real estate business. WeWork did a bunch of acquisitions that were trying to help it become or pretend to be a tech company, including acquiring Flatiron School, which it paid $28 million, which was a coding bootcamp in 2017. Also acquired Team, which is a software that lets people book meetings for $100 million. And they also bought Managed by Q for $220 million, which is an office management startup. Could there have been, or are there currently any companies out there that they could have acquired to help them justify a tech valuation or transform their business into having a tech valuation?
No, period. No, unless they would have bought Facebook, right? Like they're not a technology company. They were a poorly run real estate company. They leased space, so they took on heavy liability, invested a boat ton in their fit out, and then tried to lease it at 1.5x and sometimes did it at less than that. It was just, you can't package that any better. And they bought a lot of companies. They bought a company that we were actually diligencing. Cool company, access control. I think these guys actually were smart. They got half cash, half stock, so they actually did pretty well. That was just enablement of their real estate enterprise. It wasn't turning them into a technology company. So no, that's my opinion.
I want to discuss some of the like missed opportunities here, which, you know, we're hinting at now with the previous question, like the community building aspect. I mean, they kind of went halfway there with its promise. Like they already had a bunch of young, hungry, innovative people in their buildings. I feel they could have done a much better job at curating, you know, and connecting these members to potentially incubate new companies and launch new ideas. Like that could have really, I feel, set them apart.
That is hard. Like I think WeWork was good at it. If you talk to people there, they will swear that in their first few locations, they were really good at it. They had, you know, sort of stumbled on or made some special sauce that got people to really interact. You talk to other incubators in other cities and at the time, and some of them would say the same thing. Others were bad at it. And like definitely different co-working spaces had different vibes. Some were good, some were bad at community. I think it's probably really hard to scale it. But really what happened is WeWork couldn't keep growing that fast. You couldn't do both. You can't be, the world's corporate real estate provider, which is what they were sort of growing to become. And that's what had to become a lot of their tenants, and be a community of creators, as I think is one of their various taglines. I mean, there's only so many freelancers in a city, and they aren't going to fill 10 million square feet of space.
Right. Good point. Last thing, something I found super interesting was that it was the public markets who stopped kind of, WeWork when they released their first S1 when they were trying to go public. However, during COVID years, it kind of flipped the balance between who was driving these valuations between private and public. So if WeWork was propelled by private markets and stopped by public, now it seems like the private markets are the ones, showing caution and kind of expecting or demanding companies to show a path to profitability, while public markets were going wild with the Robinhood and the meme economy. Where do you think we are now?
Yeah, so I think right. It changes by the year. Like I think 2019 or so was the 2018 was the peak of the private markets, and being kind of way out ahead of the public. 2021, the public markets were going bonkers, as were the crypto markets, whatever those are. Both right now are pretty restrained. If you have a sheen of AI, I think in both the public and the private, it's pretty clear you get some huge like that's the special sauce today. to get some, huge lift. But, you look at that multiples, which like pretty like easy rudimentary way of valuing something. But in real estate, you do it with cap rates. In the markets, you do it with revenue or earnings multiples. And like those are sort of have pulled back on both to be more kind of historic, to revert to historic norms. And it turns out we weren't in some, brave new world where suddenly 100x revenue is normal.
Eliot Brown, co-author of the book, The Cult of We. Thank you so much for coming to Tangent today and for sharing your lessons and your insights. Pleasure to meet you.
Thanks so much for having me. Really appreciate it.
Thanks for listening to Where Will We Work Now? The Future of Office, a Tangent original series. Don't forget to follow, rate, and review us, and share the show with a friend. This series is produced by Edward Cohen. If you'd like your company or organisation to be featured across Tangent's community, you can email us at tangentcommunity@gmail.com. And remember, collaboration is our superpower. So stay curious and always be learning.